Namaste and welcome to Pods by PEI, a policy discussion series brought to you by Policy Entrepreneurs Inc. My name is Kushi Hang, and in today's episode, PEI colleague Nirjan Rai is joined by Satyam Panday to unpack his recent S&P Global publication on the economic outlook of emerging markets. Satyam is the chief U.S. economist at S&P Global Ratings. Until just recently, he was the chief emerging markets economist for S&P. He has also taught at Boston College and Brandeis University and has been a research fellow at the U.S. Congressional Budget Office. Satyam holds a PhD in international economics and finance and specializes in macroeconomics, development economics, and applied econometrics. He is also a non-resident senior fellow at PEI. Nirjan and Satyam begin by discussing the key takeaways of the report. They then shift their focus to the economic performances of China and India, especially in the context of post-pandemic recovery and the ongoing Russia-Ukraine war. Satyam also offers his take on the short and long-term projections for these two countries. They then end the conversation with a discussion on why Nepal has failed to exploit the economic performances of its two neighbors and present some thoughts on what Nepal should do next to leverage their future growth. We hope you enjoy the conversation.
Welcome to Pods by PI Satyam. How are things there with you in San Francisco?
Thanks for the invitation, Nirjan. Glad to be on Pods. Things are rather going well here. Good weather, like always, in San Francisco.
All right, excellent. So, shall we dive right into our conversation today?
Sure.
So, today we are here to discuss your analysis on the economic performances of emerging markets, especially that of India and China. Now we'll base our discussion off of a report that you published last month. To start off, could you tell us a bit about the report itself?
Sure. Let me start with a quick intro to the S&P Global Ratings itself. I think that would give a good background basis for what we do in this report. S&P Ratings, which is previously known as Standard and Poor's, it provides credit ratings on the bond and debt instruments. And those who are unfamiliar about credit ratings, a credit rating is an independent assessment of a company's or government's creditworthiness, right? Assessment of their default risk. So these ratings range from AAA to D, or rank order based on default risk. Basically, when you have a AAA, that's the highest rating assigned by S&P, meaning the debtor has extremely strong capacity to meet its financial, commitments. And as you go down the scale, the risk of default increases. So basically, these ratings, they do consider macroeconomic environment. And given these ratings are inherently forward-looking, forecasts of macroeconomic variables going out a few years are needed. You can think about forecasts for GDP growth, inflation, unemployment rates, so on and so forth. These macro forecasts in the report that you just mentioned, they come in handy for our rating analysts when they are producing their rating scores for these variety of debt obligations. So this report that you mentioned has our latest quarterly forecast for emerging market economies, and it was published back in the end of June.
Perhaps you could also let our listeners know how you define emerging markets, things like who they are and what characterizes them as emerging markets.
On definition of emerging market itself, there's actually no formal definition as such, strictly speaking, but it's still, emerging markets are generally identified based on, I would say, three key attributes. One, sustained market access. Two would be progress in reaching middle income or upper middle income levels. And three, with greater global economic relevance, right? So you can think of the size of the country's economy in terms of nominal GDP, its population, its share of exports in global trade matters, GDP per capita, the external debt in global external debt environment. All of that is relevant for the international investor types. And looking at all of those indicators, we have come up with 18 countries at S&P as our core emerging market sample countries. Obviously, these are dissimilar countries. The distinction between emerging markets and the developing economies are quite imprecise, but again, we have tried to do the best that we can here. A lot of them are in Latin America, like Brazil and Mexico, and then there are a few in emerging Europe, Middle East, and Africa. You can think of Turkey, South Africa, Saudi Arabia. And then, of course, we have our China and India in Asia, together with a few other Southeast Asian countries.
Okay, so before we get into the details of your outlook, maybe we should also have you first draw a picture of the current scenario of the global economy upon which you base your analysis. So, what would you say are perhaps some of the top determinants of the current state of the economy?
The current state of the global economy, let's say in a few words, it would be just resilient, especially given the circumstances, right? We've got global growth, inflation, and the uncertainties surrounding all of these. They basically continue to be affected by the what we call long shadow of the Russia-Ukraine war, post-COVID supply-demand rebalancing, and not the least, the restrictive stance of monetary policy, right? Especially coming out of the U.S. Federal Reserve in a world where dollar plays an important role in trade and finance. It at least appears that the impact for some of these have already either peaked, like the pandemic has already peaked, and some of the impact from the monetary policy is peaking as we speak. I suppose you could put the Russia Ukraine war still as a wild card for the balance of risk in the near term, at least. That said, the key points to our own baseline narrative for global growth is one where growth's been uneven, but it is slowing, generally speaking. The service sector has shown quite a bit of resiliency, which has sort of pushed out any of the necessary cyclical slowdown a bit away from what we have thought or anticipated earlier. In the advanced economies, labor markets, they remain quite tight, especially even in Eurozone where the region, the output has actually stalled. In terms of global trade, trade has basically stalled at the moment, meaning domestically driven economies are outperforming those that are more open to external demand, especially in the emerging market space. Overall, inflation it's falling, which is good for the households. But the core part of inflation, once you take out the energy and food prices, that core has become a bit sticky, which is bad for central banks. Central banks generally want to have the core inflation also under control and decelerating from where we were at last year. Policy rates, it seems like they need to rise further for the developed markets and stay there for some time, and which in effect basically constrains some of the downward rate mobility in the emerging market space as well. So all in all, you've got the advanced economies that are looking at a shallower and a longer downturn in the next 12 to 18 months, which should impact some of the emerging markets that rely on external demand as well. So bottom line here is, growth's been better than expected in the first half of the year so far overall, but we see a slowdown for the year as a whole compared to last year.
And now that we have the context sorted out, let's get into your analysis of the report. So, in your report, you highlight the following as one of your key takeaways, and I quote: "Despite better than expected growth in the first quarter, we continue to forecast a sharp slowdown in 2023 for most emerging markets." And you just stated that towards the very end. Now, can you walk us through this analysis?
Yeah, sure. We expect real GDP growth to slow sharply this year in most EMs. And it's quite normal to have sharp slowdown when you saw such a remarkably strong performance last year. Especially for a lot of these emerging markets, we had a nice bump up rebound from the post-pandemic opening up last year. And that excludes China and Thailand for last year. But for this year, we're going to see China and Thailand that came out of the post-COVID restrictions a little bit late. They are going to be the ones that will see a rise in their growth picture. The rest of the EMs, the countries in Europe, the Middle East, and Africa, as well as in Latin America, they're going to grow well below long-term trends the next 12 months. Meanwhile, emerging Asia, which are, excluding your Chinese economy, they should see a slowdown, but will remain respectable, we think. India and countries in Southeast Asia will grow a tad under the longer run trend. So it's a more mellow slowdown rather than a sharp slowdown for Asia, at least. Again, like I said before, EMs, they generally tend to be a varied set of countries with country nuances. But generally, the common theme here is that external conditions will be tough for export reliant countries with weakened demand from these key major trading partners like US, Eurozone, and even China for that matter. China has been the growth engine of the world, and its growth target of 5% for this year is relatively unambitious, right? Post-pandemic recovery momentum is also fading for most EMs, and that's not going to provide the same impulse to growth anymore. Prices of energy and food, they continue to be at risk for staying high for longer, given the war in Ukraine, which is an important growth risk for EMs, especially since the consumers in these countries, they tend to spend larger share of their income expenditure on food and energy. So we see EMs, after this year, after 12 months, basically, EMs gradually returning to their longer run potential growth rates later in 2024 and 25 as inflationary pressures recede and central banks ease interest rates. In fact, I would say monetary policy has already started to ease. At least it appears to be that way, that monetary easing is underway, especially in the likes of those that were already having very high interest rates to begin with, like such as Chile, Brazil, Hungary, those come to mind. Others are also likely to follow suit in the coming months, but most will have an eye on the US Federal Reserve's signals on its own interest rate outlook, especially to protect capital flows and manage exchange rate pressures coming from interest rate differentials with the world's reserve currency.
Right. Satyam, now let's dig deeper into the performance of the two countries that most of our listeners will probably have a larger interest in. Let's begin with China. And I believe a good starting point here would be to discuss your take on China's post-pandemic recovery. So how do you think China performed in terms of rebounding its economy from the COVID slump?
China is an interesting case because it came out of COVID restrictions late in the game. And the bounce from that lifting of COVID-19 restrictions and the reopening of the economy has been surprisingly limited and seemingly short-lived, at least in the first instance. China's economy picked up in the first quarter of 2023. It was led by consumption and services, but that recovery in consumer demand has been weaker than most had anticipated, especially in the recent months. And, we've seen consumer confidence is also recovering only slowly. We just haven't seen the same burst of pent up rebound that we saw in the US and other advanced and emerging economies when they came out of the gates after COVID restrictions were lifted. Overall, you've got unemployment that has eased in China, meaning unemployment has come down, but you still see the youth unemployment rate has been rising, which has basically soured the already subdued sentiment, that had been coming from the housing market weakness, slower income growth, and some pay cuts in some sectors. At the same time, generally China would have had uh, robust investment picture with the property sector really picking up, after some stimulus. But this hasn't happened this time around. Confidence has also been weighed down by this continued weakness in the housing sector. Just in general, the investment picture remains muted for now, with subdued investment and exports. Industrial production momentum has just weakened.
What is your forecast for China's economy in the near term? Some have said that the weak data of the Chinese economy has increased pressure for large stimulus measures.
Yeah, we revised down our China GDP growth forecast. Now it's 5.2% for 2023, which is a positive in the sense that it is a growth rebound from 3% growth that we saw last year. But keep in mind that it's very low by historical standards. While consumer demand is likely to continue to recover in the second half of this year, weak exports and confidence will continue to weigh on private sector investment. Our view here, our Chinese, economists and analysts have the view that the macroeconomic policy at least is likely to be supportive, but not significantly expansionary like how it used to be in the past, especially given the indications at the National People's Congress meeting earlier this year. Policymakers are aiming for an organic recovery from the pandemic, and they are keen to contain financial risks and leverage. Right, so we did see a minor interest rate cut just recently, but concerns about major currency depreciation limits the room for more interest rate cuts. Um, Again, a little bit forward looking, if there is further setback to growth, or confidence is coming uh, low on the next few months still, it would likely trigger some more measures to include increased credit and infrastructure financing type of support, or maybe an easing of house purchasing restrictions and some fiscal support for certain types of consumption. But I would say that these kinds of support would be very limited, and should effectively seen as putting a floor under growth rather than giving a huge boost to growth, right? So basically a floor. Um, the biggest near-term headache, near-term for the policymakers right now in China is a loss in private sector momentum, which is causing weakness in job creation to absorb this rising proportion of young talent, graduating with improved education, global awareness, and higher expectations for living standards than their parents.
And what do you see the impacts of this having on the other economies that are very reliant on how China is doing?
Yeah, just bringing it back to the rest of the emerging markets, at least. What would it mean for the rest of them? Basically, especially the growth move that's sort of going away from your infrastructure and property type sectors, and more on a domestic demand base, consumer type of spending. This is not your traditional growth driver that China used to have, right, pre-pandemic. uh, it just means that there will be less support for growth to the primary resource commodity exporters in the EM space, like some in Latin America, some in sub-Saharan Africa, those who rely on exporting to China heavy iron ores, metals, commodities. So these exporters, they're not going to enjoy the same form of export growth as they did in the past. Um, that said, countries that have a larger share of Chinese tourism, some parts of Southeast Asia, especially led by Thailand, for example, they will likely benefit from. There's still this pent up travel demand of Chinese households that just hasn't been completely unleashed. So we do think that some of that is going to help at least the Southeast Asian travel economy in the near term.
And beyond just the near term for China?
Well, beyond near term, though, I can't stress enough that this era of double digit real GDP growth of the 2000s and even 6ish and 7ish% growth in the years before the pandemic are now, it's behind us, right? We should not expect China to be growing like that anymore. China's trend growth itself will slow even as the so-called catch up or the convergence to high income advanced countries will continue in the coming decades. We project the potential GDP growth itself, which is basically the structure of the economy. Based on the structure of the economy, it's going to ease to about 3.6% by 2030, and close to 3ish% in the next couple of decades on average. But don't get me wrong here. This is a slowdown, but it's a natural, inescapable slowdown, right? And it can actually be mostly healthy. We see slower growth as mainly deriving from demographics, rebalancing, convergence, and a degree of decoupling by the U.S. and other economies. I think maybe I should explain a little bit here on these four different points. First, the point that I made on demographics, that's just simply the working age population in China is shrinking. It's just, demographic destiny, moving from a labor surplus economy to a labor shortage economy, right? Secondly, on rebalancing, more broadly speaking, services and consumption will be the keys to driving the economy moving forward more than manufacturing and investment that we had seen in the past. Rebalancing from manufacturing to services and investment to consumption. These are, just to let you know that, in case of productivity growth itself, it's always and everywhere that services tend to be a little bit slower in its productivity growth than manufacturing. So that itself is also going to impact the growth trajectory. A key objective of all of this rebalancing, of course, is to foster a more innovative economy that relies less on the old drivers of growth and more on, your advanced manufacturing and technology-enabled services. This type of rebalancing also calls for lower investment spending on crude resources, heavy infrastructure and construction, and it allows for more of this increased share of growth coming from domestic consumer spending, and that's what they're trying to do here by rebalancing. Thirdly, in that point, on the points that I made on convergence, basically the main idea here is that China is getting richer, and there is just diminishing scope for technology transfer and catch up, and especially with in the sort of those provinces which are much more richer than the rest. And lastly, an important one, I guess, these days is on decoupling, which is also called the so-called the great game of trade and technology tensions with the U.S. Which started even before the pandemic, but it's ongoing. It is starting to become more and more loud in the news cycle. It seems like it's not only likely to slow the Chinese technological progress and impede productivity, at least through the next few years, but also make the slowdown harder to manage. Obviously, this is not to say that it's only China that's going to be bearing the cost. It is more than China, right? It is both parties here. When you are moving away from free trade and technology sharing, they tend to bear the costs, obviously. So yeah, that's basically your beyond the near term prospects for China that we see, at least at this point.
Hi there, this is Kushi from Policy Entrepreneurs Inc. We hope you're enjoying Pods by PEI. As you know, creating this show takes a lot of time and resources, and we rely on the support of our community to keep things going. If you've been enjoying the show and would like to help us out, we'd really appreciate it if you could become a patron on Patreon. Patreon is a platform that allows listeners like you to support creators like us with a small monthly donation. Your support will go a long way in helping us to continue creating high-quality content for you. So if you're interested in supporting our show and becoming a part of our community, head on over to Patreon and become a patron today. You can find us at patreon.com/podsbypei. Every little bit helps, and we can't thank you enough for your support. Now, let's get back to the episode.
So now let's move on to the other country of interest for many of us in the region, India. Now, unlike China's the post-pandemic growth story, the Indian post-pandemic growth story seems to have a more positive view from many analysts, and this is true also of your analysis. So, what would you say have been the key drivers behind India's recent economic growth, and what is your outlook for the Indian economy?
Well, India has come out of the pandemic reasonably well, with GDP growth of 7.2% in the fiscal year 2023. This fiscal year 2023 is basically the way that they do it is it starts in April of the year and goes through March of next year. So basically, fiscal year 2023 would be the year that ended in March 2023, just to be clear. Uh, so it did come out of the pandemic reasonably well, but expansion is likely to cool in this fiscal of 2024 to about 6% due to global slowdown and some of the lagged effect of policy rate hikes by the Reserve Bank of India. But and even at this rate, India will still be the fastest growing economy in the G20. We've got consumer demand, which is slowing against this backdrop, but again, just slightly. And urban consumers are still faring better than the rural ones. Agriculture and construction activity has shown resiliency in India so far, at least. But still, we think that the agricultural performance in the coming fiscal year may be affected by what we call the El Nino conditions, right? This El Nino, just to be clear to the listeners, it's as it's commonly known, it refers to an abnormal warming of surface waters in the equatorial Pacific Ocean. It's known to suppress monsoon rainfalls, basically. So if that condition is in play, we do think that there may be some underperformance from the agricultural sector in this fiscal. But again, the key here is that beyond this fiscal year, we still expect growth to come in at 7% on strong investment and consumer demand, domestic consumer demand. And at the same time, headline consumer inflation should soften to a little bit under 5% than what was a 6.7 last year. I think some of the supply side, inflationary pressures have receded, and demand also, the tempering of demand will bring the core inflation down too. We think both inflation and then the rate hike cycle have already peaked in India. We don't expect the Reserve Bank of India to cut rates until early 2024, since it first wants to see consumer inflation moving to 4%. That's the center of its inflation target range.
Okay, and what beyond the near term? It also appears that many analysts are quite optimistic about India's performance in the mid as well as longer term growth. How do you see that?
Yeah, beyond just near term, of course, this is the $1 trillion macro challenge, right, so to speak, for India in the coming 10 years and beyond is to turn what used to be, traditionally an uneven growth picture since the liberalization days, back in the early 90s. How do we convert that? How do we transform that into a more high and stable growth trend, right? Can India replicate that performance of the East Asian tigers over the recent decades, and improve its prospects for the large and growing workforce. There are some structural differences, India versus the East Asian economies, and given such differences, I would imagine India will need to follow its own unique path. India's economy is more domestically driven and services oriented compared to the East Asian tigers, so its path to success will have to be different.
Yeah, and what would that desirable path be?
Um, my colleagues at work at S&P Global, they just put out a look forward report on India just the other day, actually, which highlights that, and at the end of the day, it's the capital accumulation that will drive India's economy towards this, desirable path, with the government and increasingly the private sector investing in infrastructure and manufacturing. Digital infrastructure, especially, is another potential driver of high growth. But again, having said all that, it's still, going to be service sector that will continue to be the biggest driver. Especially driven by the domestic demand. It's a large domestic market, as well as the global outsourcing that it already is plugged into. Um, you know, it's fair to say that many are giddy about India, including uh, most people that I know and myself. I feel like it is probably about time. And we have seen some of the things already happening. Physical infrastructure, like, for example, is improving connectivity and lowering logistics costs for industries. Uh, the authorities, they've been sort of been very much in the game of unlocking some of the productivity enhancing outcomes that comes from infrastructure and logistics development that eases bottlenecks in the economy. Labor laws and the land acquisition process, those have also been gradually eased. You can think of digital infrastructure, which will continue to speed innovation, improve payment systems, and reduce leakages from government subsidy transfers as well. Moreover, this is the time. India has used its G20 presidency to highlight its digital public infrastructure success and to encourage action on enhancing some of the financial inclusions for other countries as well. So these are some steps that really some concrete steps that they have taken that does give me more confidence that maybe this is the time that they will definitely uh, have a sustained period of stable growth. You know when you look at manufacturing, I think the boom in Indian mobile phone production provides a template for the future policies in other sectors as well. India's policy intervention in the smartphone, if you remember, just a few months back, that sector has illustrated its ambitions for manufacturing as a conduit to service the domestic market as well as its geopolitical aims, right? Especially given smartphones are among the most sophisticated manufacturing products, and just getting those logistics into your own country, that's just a logical target for any country that's looking to extend its economic development, I think. But anyway, in summary, I would say in a long-winded way, but again, this path to success will ultimately depend on India's ability to reap its demographic dividend, right? Increase labor force participation, including upskilling. Some of the skills have to be definitely upskilled. Education is important here in order to tap the global supply chains on a higher value chain. Boost private investments with structural reforms in land, logistics, labor, and increased competitiveness, especially driven by foreign direct investments. And in all of this, geopolitics could provide considerable tailwinds.
You mentioned geopolitics, and this is something that I would like to dig a little deeper into. Now we all know, and you've mentioned this as India being quite ambitious, especially of late, in terms of projecting itself as a global player. One might even say it considers itself as an important node in a multipolar world, right? So how do you see India's growth in this context of ability to exploit the new global geopolitics emerging from the competition between West and China?
I'm not a political economist or a political analyst, but what I can tell, at least from my own conversations with folks who know more than I do, is that geopolitics can cut both ways, right? It appears, at least right now, that the country, India, is in a good geopolitical position, which will help it benefit from the supply chain diversification, the friendshoring that we have started to see as policy driven, policy driven specific agendas coming out of the West and against, or you should say, sort of competing with China. But still, these geopolitical volatility can be a challenge too, right? It appears, at least right now, India is pursuing somewhat of a pragmatic approach, if I'm not mistaken, by cooperating and competing to serve its own national interest. But it also means we shouldn't think that it's not going to be challenging. It is. It does have to navigate some changing partnerships and evolving landscape. And on top of that, for any economist, deglobalization and some of the protectionist measures that it comes with, those should be creating headwinds for exports growth. It just creates a little bit more uh, of inefficiency than what it would otherwise happen. But again, having said that, trade partnerships, maybe in terms of friendshoring or staying neutral, those kinds of trade partnerships should help to mitigate some of these effects.
Okay, excellent. So, Satyam, now we're coming towards the end of our conversation today, and for the next two questions that I have for you, I'd like to take you away from your report and ask you to respond as a Nepali and as an economist who looks at global economic performances. Now, you know that our Nepali development narrative has revolved around exploiting, or rather, having failed to exploit the economic performances of our two giant neighbors. So, as someone who understands the economic characteristics of Nepal, and someone who studies extensively the past, the present, and the future growth of Nepal's two neighbors, China and India, I'm keen to hear your thoughts on why Nepal has not been able to ride the coattails of these two economies. Let's begin with China. So, asking frankly, is it just our lack of capacity, or are there peculiar characteristics of the Chinese growth model that has made it difficult for countries like Nepal to exploit? And as you look into the future of China's growth, and we've discussed some of these earlier, um, what do you see as some of the uh, do you see specific opportunities opening up that Nepal could potentially exploit?
Yeah, as a regular observer of the Nepali economy, and what I understand, I think it's partly true that it's our own capacity or the lack thereof. And also, it's true that the Chinese growth model in the past was just not conducive for the Nepalese economy to, sort of reap the comparative advantage out of, right? If you remember, the Chinese growth model was heavily reliant on infrastructure and export led development, right? Infrastructure investments that require tons of natural resource based exports to that country. So basically, China was importing a lot of, iron ores and, copper and, coal, which we just don't have the ability to provide. If you think of Chile, which just happened to be a huge copper producer, they reap the benefits of that, right? That industrial growth of China. If you think of South Africa or some sub-Saharan African countries, they had those, primary natural resources, those primary commodities that is needed for such large infrastructure developments that China went through. And then on the export side of things, Chinese, manufacturing exports was based on very cheap labor, to be frank, and we just could not, compete with that either. So all in all, it just wasn't, both our capacity as well as the Chinese growth model itself was just not conducive for us. It was just not favorable for the Nepalese economy, I think. And then, moving forward, though, I think some of the changes, some of the rebalancing that China wants to do and is in the path of, it may actually be more conducive to Nepal, especially given now that the Chinese economy itself is of a higher income, and so those labor wage gaps have also closed. Uh, we might just be able to be more competitive with them, and we could be actually providing some consumer-based goods, which is what they want to increase the consumer demand, the internal domestic demand. And we could also be providing more on the tourism services sector now that the Chinese, population is much richer than before. They want to go out, they want to visit new places, and I think Nepal could be one of those. I think we've already seen some of that happening, but it could be a lot more than what we have seen lately, and so that would actually play into our own comparative advantage as well. But all in all, outside of trade, there are, the other side of the coin is the capital flows. The access to the Chinese capital would be another one. We do need some foreign direct investments into a lot of these infrastructure projects and other things that we are trying to, advance in Nepal. I think the Chinese surplus savings and some of their investment funds could definitely help be channeled towards our own development purposes.
Okay, and shifting the conversation to the south, why hasn't Nepal been able to exploit India's growth? And as India positions to become a player in the global economy, which you seem to be very fairly optimistic about, what are your thoughts on how Nepal should position to exploit India's growth in the coming days?
This is also a tough one to answer. I'm not so sure exploiting how, but what we have seen around the world at least is that if a smaller country can plug itself into some form of the industrial complex of a larger, neighbor, like Mexico with U.S., or even it doesn't have to be right next door neighbor. It can be even, just friends of distance, like the German vehicle, industrial complex is plugged into South Africa, for example. Uh, we could potentially try to, make some uh, rules of the game change, so to speak, in order for the Nepalese manufacturing base to be plugged into what India is trying to do in its medium to long term, which is get into increase the share of manufacturing, increase the share of uh, AI related, some of those. Service sector as well, where maybe our own engineers and highly educated workforce, some of whom we already have, I know, they can get plugged in as well. But again, at the end of the day, I think for Nepal, we still need to have a lot more, upskilling in the labor force, just like how India needs to do for itself. I think Nepal has the same problem. Lots of upskilling is needed. The speed of infrastructure development, including power supply, is quite key for us. Some of the some of the urbanization rates. I think Nepal still has a relatively low urbanization rate, which needs to change in a more sustainable manner, obviously. But all in all, it's a you know it's rather something that our own policymakers need to have sort of a diplomatic way of cutting some deals with the Indian policymakers, get into that financial and industrial complex that India is trying to expand for its own economy. And it should be easier for us, I think, at least, to be in the coattails of India rather than China, right? Just because, given some of the similarities in languages and the open border systems that we have, I would imagine it's much easier to be, sort of going parallel with the Indian, economic growth for the next, decade. If it were to really happen, then not. The one downside, though, I do see is then you are reliant on the Indian side of things, and often in the past, it has been reminded to us that it's better to be a diversified economic model rather than just a one country reliant model. So that sort of gives me pause, but still, I think we should be able to somehow, get some of that growth impulse from the Indian, growth moving forward as well.
Yeah, this is indeed the $1 billion question for our development story. But thanks for taking a stab at what you think we should be doing. Well, that's all from me today, Satyam. Is there anything else you'd like to convey to our listeners? Maybe give a few insights from your work. Anything you have for?
No, this was a very nice way to, I guess, end my engagement as the chief economist for emerging markets at S&P. I just recently got moved to a new position. Now I will be heading the U.S. and Canada economies. A lot to do there, of course, as you know, from the energy transition and AI-related policies that have been put in place by the American legislators. And then you've got the China-U.S. decoupling, ongoing decoupling agenda, but it should keep me busy, all of that. But I'm very happy that you had me here, my last words on the EMs, at least for some time to come.
All right, congratulations on your move, and hopefully we'll have some time in the coming days to bring you on board once again to Pods by PI to discuss how the economy is featured in the upcoming US elections. But with that, we have come to the end of our episode. Thank you, Satyam, for this very insightful conversation and for accepting our invitation to be part of Pods by PI.
Thanks for having me, Nirjan.
Thanks for listening to Pods by PI. I hope you enjoyed Nirjan's conversation with Satyam, where they unpacked his recent publication with the S&P Global on the economic outlook of emerging markets. Today's episode was produced by Nirjan Rai with support from Nitesh Sapkota, Sonia Jimmy, and me, Khushi Han. The episode was recorded and edited by Nirjan, and our theme music is courtesy of Rohit Shakya from Zindabad. If you liked today's episode, please subscribe to our podcast. Also, please do us a favor by sharing us on social media and leaving a review on Spotify, Apple Podcasts, Google Podcasts, or wherever you listen to the show. For PEI's video-related content, please search Policy Entrepreneurs on YouTube. To catch the latest from us on Nepal's policies and politics, please follow us on Twitter at tweet2PEI, that's TWEET followed by the number 2 and PEI, and on Facebook at Policy Entrepreneurs Inc. You can also visit pei.center to learn more about us. Thanks once again from me, Khushi. We will see you soon in our next episode.